Today in this video, we're talking about the 7 dividend stocks that pay me an average of $331 every single month. Dividend stocks have been very much out of favor ever since the Fed went on their rate rising cycle. And to illustrate this, we can compare one of the best dividend ETFs out there, considered the gold standard of dividend ETFs by Morningstar, the Schwab US Dividend Equity ETF, and that's ticker SCHD, very popular dividend ETF. That ETF is only up about 6% on a one-year basis in comparison to the S&P 500, which is up 24% on a one-year basis. Although the dividend of SCHD is more than double what the S&P 500 dividend yield is, that 3.47% on SCHD is not making up for that nearly 20% difference between the two ETFs. Dividend stocks will become favored again once the Fed starts their lowering cycle. Once they bring those Fed funds rate down, it's going to be a lot more attractive to be a dividend investor again. What a lot of investors think is, why would I take the risk on a dividend stock that's paying me 1%, 2%, 3%, somewhere around there, when I could just put my money in T-bills or put my money in a high yield savings account? Like myself, I use SoFi and I have a 4.6% yield on my savings. That yield I get on that money is higher than multiple dividend stocks that I hold in my portfolio. And with that, there's nearly zero risk. There is zero risk of downside with my savings money that I'm getting a 4.6% rate on. Obviously, there's no upside either. That's why we like to be dividend stock investors, because we can get that price appreciation and the dividend yield at the same time. If you also want to get a 4.6% yield on those savings balances, I'm going to put a link in the description and in the pinned comment below. All you've got to do is open an account, fund it with at least $25 within a month of opening the account, and then set up direct deposit. You can also get up to a $300 bonus if you set up direct deposit up to $5,000 within the eligible period. And then you can get that risk-free 4.6% yield. Real quick, before we get into those 7 dividend stocks that pay me an average of $331 every single month. If you're new here, welcome. I'm Austin. I'm a co-owner of cloudmusicsuite.com. I'm also a stock market investor. If you're not subscribed to the channel already, become one of those 4,200 or so people and drop a like on the video. Helps the channel out in a massive way. All right, let's jump into it with stock number 1. First stock on the list is Waste Management. Waste Management pays a 1.47% yield. Stock is currently around $200 with about a 25% gain on a one-year span, which is beating the S&P 500 by just a little bit, and the dividend yield is higher than the S&P 500 as well. The reason I like Waste Management as a dividend stock that I'm going to hold for many, many years is that this business model is extremely difficult to disrupt, and it spins off cash like nobody's business. It's so stable. There's not going to be a time where we don't have trash to haul anymore. There's not going to be a time where we don't have recycles to process anymore. The industry they're in is a very difficult one to disrupt and a very difficult one to start a new business in. There's a few massive players in this industry, and then everyone else is just a small fry. So as it relates to disruption and beating them out and out-competing them, it's probably not going to happen. The chances are very, very, very small. Waste Management has grown their dividend every single year for 20 years straight, with a 5-year compounded growth rate of that dividend being 8.21%. That's a very respectable raise every single year that you're going to get. And with a payout ratio of 42.99%, it not only looks like Waste Management's dividend is very, very secure and stable and not going to get cut, but they also have a lot more room to raise that dividend. Once the payout ratio gets near 60%, we get a little worried about the dividend growth rate over time. But as long as they're below that, and Waste Management is clearly well below that, they have plenty of room to continue raising that dividend over time. Dividend stock number 2 on the list is Lockheed Martin Corporation. This is ticker LMT on the market. The dividend yield is currently sitting at 2.76%, and the share price is roughly $456 a share. Lockheed Martin stock has underperformed the S&P 500 by a whole lot over a one-year span, with the stock only being up about 1% over 1 year. With their current price to earnings being about 13% lower than their average price to earnings, I see a nice pop coming in Lockheed Martin stock sometime within the next 12 months. The reason I like Lockheed Martin stock as a dividend company is so similar to the reasons I like Waste Management as a dividend company. Number 1, extremely difficult business to disrupt. Lockheed Martin also has the added benefit of almost all of their revenue coming from government clients. Government revenue is very stable and it is nearly guaranteed. And this industry is nearly impossible to disrupt in a short period of time. It would take decades and decades for a company to be rivaling the big aerospace and defense companies like Lockheed Martin, Northrop Grumman, Raytheon, etc. Lockheed Martin has been able to raise their dividend for 21 years straight with a 5-year compounded dividend growth rate of 7.68% and only a 44% payout ratio. So that's once again well below that 60% payout ratio that we'd like to see as the upper limit. It's way below that at a 44, so they've got tons of room to raise that dividend over time, and the dividend is extremely stable right now. There's really no chance of it being cut, and an extremely high chance that we get another dividend raise every single year. So that $12.60 dividend that you'll get every single year is only going to go up over time. Stock number 3 on the list is Costco Corporation. This is ticker COST on the market, and this is the lowest yielding company on the entire list. But there's a couple things that are really special about Costco as it relates to dividends, and we'll get into those here in just a sec. Costco's trading at $853 a share as of recording this video, and the stock is up an amazing 61% over the past year and a crazy 227% over the past 5 years. This is one of the best stocks in the stock market and absolutely one of Wall Street's darling stocks. It's difficult to find a management team that runs their business better than Costco's management team runs their business. And they're honestly the best run retailer out there, and I have no worries about Costco's future growth. They're just going to keep on firing on all cylinders just like they have for the past multiple decades. I told you there's some special stuff about Costco's dividends, and the first thing is that their 5-year dividend growth rate is 12.33% on the dividend. That is very high for a dividend growth rate, and they've been growing it for the past 19 years straight every single year. And although that annual payout is only $4.64 with a 0.55% yield, the other really special thing is that Costco over the years has paid these special dividends that are very large amounts. 2012, they paid a $7 per share special dividend. 2015, they paid a $5 special dividend. 2017, $7 special dividend. 2020, $10 special dividend. And then 2023, a $15 per share special dividend. So the yield, taking those special dividends into account, is really more than double of that 0.55%. If Costco continues paying these special dividends. I do think they will, and it seems like they like to do this once every 2 to 3 years. Of course, it's no guarantee, but they have made a ton of shareholders happy over the years with these special dividends, so it'd be very wise for them to keep this up as long as their cash flows allow them. The next stock on the list is STAG Industrial, and this is ticker STAG on the market. This is the second highest yielding stock on the list, and it's the only monthly dividend payer on the list. So every single month, you're going to get a dividend from STAG. The dividend yield on STAG is 4.24%, and every single month, you'll get 12.33 cents every single share that you hold. STAG is actually what we call a REIT, a real estate investment trust, and specifically, they're an E-REIT, which means equity REIT. They own the properties that they end up leasing to their tenants. The higher Fed funds rate has absolutely hurt STAG's business model and has hurt their profitability, which has in turn hurt their stock price. It has not hurt their dividend payouts. They have been very consistent every single month with that dividend payout, not ever lowering it, and even raising it a little bit over time. But I like this equity REIT because most of their portfolio is in warehouses, and they have so many different tenants. They're insanely well diversified. Their largest tenant is the big dog Amazon, but it's only 3% of their entire rent that they get on a yearly basis. So that just goes to show you how well diversified this business model is. They're not concentrated on just one customer. There's a lot of equity REITs out there that if they lose one of their big time tenants, they're going to lose 20 or 30 or 40% of their entire rent revenue. And that could be very damaging for a company, for a stock price, and of course for that dividend. A real estate investment trust is always going to have a much higher payout ratio than a common equity stock. So the payout ratio is 61.95%, which is actually very low when you compare it to other REITs out there. 5-year dividend growth rate of a little bit less than 1%, but they have been growing the dividend every single year for 11 years straight. When STAG's really going to get a pop is when Fed funds rate starts to come down, so they can have a lot more cost savings because it's going to be cheaper for them to service their debt. The next stock on the list here is Visa. This is ticker symbol V on the market with a 0.77% yield, which is definitely lower than the average stock on this list. But there's a big reason why I'm okay with that dividend being lower, and we'll talk about that in just a sec. Visa's sitting at $270 with an extremely low payout ratio of 21%. That amazing payout ratio, the stability of Visa's business model, and this extremely strong, highest on this list, by the way, 5-year compounded dividend growth rate of 15.93% and a 15-year straight dividend growth track record. All of that makes Visa my number one pick for a brand new dividend investor who wants to get started with dividend stock investing. That low yield is going to get you used to going for quality companies and not going through yield chasing and going for these 13 and 14 and 15% dividend yields all the time, but actually being okay with that sub 1% yield. It's going to give you very nice dividends over time, and even better than that, the growth rate on the dividend is absolutely ridiculous. So if you want to be a dividend stock investor, and specifically a dividend growth investor, Visa is definitely at the top of my list. But the next stock up on the list is absolutely a high yielding dividend stock. I don't just own those low yielding, high growth companies. I own some higher dividend yield stocks too. And this one here is AllianceBernstein. And this is actually not a common stock, but it's a master limited partnership. And a warning on this is that the tax treatment is a little bit different for MLPs, master limited partnerships. You'll have to get a Schedule K1 form. It'll be sent directly to you from the partnership, and it takes a little bit extra tax work, but you can actually write some of your distribution income off from MLPs against your earned income. And also make sure you're not holding the stock in a tax sheltered account like an IRA or a 401k. It should be in a traditional brokerage account only. Okay, that's enough tax talk. Let's talk about the dividend yield on AEB. 8.36% dividend yield, and the stock is sitting at $32.98 as of today. MLPs like AEB are required to pay out a very high percentage of their earnings to their unit holders through distributions or dividends. But AllianceBernstein takes it one step further, and they pay out 100% of their adjusted earnings every single quarter to their unit holders. This results in a variable dividend. The dividend is not just up in a straight line like a lot of these dividend growth stocks. It's not necessarily going to go up every single year. In a better year where the company is making more money, you're going to make a lot more dividend money as a result because, like I said, they're going to pay out 100% of those adjusted earnings every single quarter to their unit holders. And that's why they've got over an 8% yield on the stock right now. I've gotten my largest dividend checks in my entire life from AllianceBernstein. And even though AllianceBernstein pays out 100% of their earnings every single year, and they've got that variable dividend, they've still got a 2.5% compounded annual growth rate on the dividend over the past 5 years. So if you're looking for that higher yield and you're okay with that stock price being a little bit slower moving, and you're okay with that K1 form, AllianceBernstein might be a stock worth looking at. And then the last stock up here is 3M Corporation, and this is ticker MMM on the market. They've got a 2.77% yield right now, and the stock is sitting right at $100. This is definitely the weirdest one on the list because this is the first year that 3M has not raised their dividend payout in over 64 years. They had 64 years straight of raising their dividend every single year. But they recently spun off their healthcare business, which is now Solventum Corporation, and it trades on the stock market. So anyone who was holding 3M shares like myself actually got a bunch of shares of Solventum Corporation put in their account for free. So that was really cool, plus the stock price appreciation, plus the dividend yield I've gotten over the time that I've been holding the stock. So even though they broke their streak of 64 years straight of dividend increases, they have not broken their streak of 100 years straight of consistent dividend payouts every single quarter. 3M's board of directors takes pride in that, and they are going to keep that dividend instated no matter what it takes, and they're not even in a bad spot after that Solventum Corporation spinoff. The payout ratio now is a very modest 36.2%, which is a lot lower than some of the stocks that were on this list that are way less established dividend companies. So that's a very impressive dividend payout ratio for a company like 3M, and I'm excited for them to restart their dividend growth journey over the next few years. If I had to guess, I'd say they're going to keep that dividend payout ratio below 40%, and instead of raising the dividend like crazy over the next 2 to 3 years, they're going to actually pay down a lot of debt to put the balance sheet in a better spot for that much needed long-term stability before they start going crazy on increasing the dividend over time. Let me know what dividend stocks you're holding right now, and if you own any of these dividend stocks I talked about in this list. Check the link in the description and pinned comment if you want to get a 4.6% yield on your savings balances and get a little bit of money when you open the account and fund it with $25 and get an extra bonus if you enable direct deposit. I personally do the majority of my banking with SoFi, and I enjoy that 4.6% yield on those savings balances. Let me know what stock I missed on this list or any stocks you think I should look into that are beastly dividend stocks that you hold in your portfolio. Thanks so much for being here. Have an amazing day.